Welcome to the September Global Market Outlook. Thanks for joining the call. Let's get started. Once more into the breach difference. So it's been another difficult month on equity markets and financial markets, and just about every segment of the international financial world, I suppose. But we'll look at each of them in order. So just to start off with, I normally do an introduction, just headlines, what's happened over the last month. Remember, we do these calls once a month. So I'll just kind of catch up on what's been moving markets and what's happened. Then we look specifically at the equity markets, look at offshore versus local, and we look at some economic indicators. We also just have a quick review of the commodity markets as well as the currency markets. Currencies, we look at some of the technical stuff. We look at the big bank estimates as well. Then we normally look at the global equity portfolio, but I've started chucking in a couple of investment ideas, and I want to take you through a specific company today, which I was asked to speak on for one of the radio shows, and it kind of started digging into it, and it's an absolutely fascinating story. So I've just included it here. There's a couple of slides on it. You are probably going to have to do your own research on this one as well, so because it is quite involved, but it looks interesting to me. So we'll get to that a little bit later on. So before we start, what do we do? Who are we? For those that have never joined us before, Rand Swiss is currently the number one stockbroker or number one securities broker in South Africa. We also have the best tax-free savings account, and we won a People's Choice Award last year. We're actually in the midst of the awards session at the moment, so the vetting process. So as soon as this webinar is finished, I go back to kind of answering very long questionnaires about our risk metrics, our risk structures, and how basically our products work, how we give access to our systems, all sorts of things for Intellidex, who vets us. It's a very, very robust survey. But our business is basically broken down into online trading, private broking, managed portfolio, structured products, offshore transfers, wealth management, tax savings. So there's a couple of different areas. This webinar specifically, kind of caters to our online trading clients who don't get to speak to dealers, in private. Private broking guys obviously have a personal dealer that they can chat to and, bounce ideas around with. So if you're an online trader, you probably don't have that. So we encourage you to come to these sorts of sessions. I will give you a couple of trade ideas, kind of just catch you up on the board market. We also do all sorts of other webinars, so check out our events section on our website, randswiss.com. That will have all the upcoming events. We do platform training, technical ideas. Viv does a lot of stuff there as well. Yaku does some of the wealth management stuff if you're interested in RAs and tax structuring and basically how to build wealth. This is also very good for managed portfolios because we're obviously reviewing our global equity portfolio. This is specifically what this is for. It's by far our biggest portfolio at the moment. It's normally, we can chat about the structure of that maybe separately. But yeah, we've been running it since kind of mid 2016 formally, and before that, we kind of used the same methodology for a couple of years as well. It's done very, very well. It's outperformed for sort of, I think, it's 5 of the 6 years, 4 of the 6 years. I'm not sure kind of exactly where we are now, but we'll have a look at that later on. Structured products, obviously, I have actually got 2 structured products that I'm going to chat about today, just very, very quickly. Talked about them last month, but the NASDAQ has obviously come down, so I think there's a nice entry on them again. Offshore transfers, we tie that all together. Obviously, we give you very, very low cost offshore transfers because we work so much in the international space. So we register with the Reserve Bank. We run that through the Investec Treasury Desk, but we can give it to you a lot cheaper than if you went directly to your bank as a retail client. Obviously, as a Rand Swiss client, we don't see it as a money-making exercise. We're just really doing it to tie all of our international products together. So how have we done? As I said, we're winning all sorts of awards, which is great. I'm really happy because for us to try and take on the big banks is very difficult. We're a much smaller organization than a standard bank, which is I think the largest bank in Africa by assets, and they usually come number 2. So so if you go look at I don't think I've got the rankings here. There we go. There you go. Have a look at the rankings there. You can see Standard Bank came number 2. We came number 1 last year. As I said, most of those companies are big listed companies. We're obviously a private company. So really happy to see what the guys have managed to do. Just also a quick word on our research offering. We've really beefed it up over the last couple of years. So private clients are now getting, some of Anthony Clark's stuff, which is I'm so excited about. I mean, it's really good quality stuff. He covers small and mid cap stocks that just no one really has time to have a look at. The big institutions don't really look at them either, and nimble private clients can do very, very well there. Verve obviously does this podcast once a week. If you haven't caught it, we've got it on the YouTube channel every week. Go check it out. Verve's always maybe a little bit depressing, but always entertaining as well. And then Christoph's sending out trade alerts as well. We've got another kind of external house that's also coming up. Very, very excited to announce for the online trading clients as well, or for everyone really. We've just kind of contracted with Garth McKenzie as well. So if you know Garth McKenzie from Business Day and Traders Corner, he's going to be doing a 5-part series for us starting in October. So every week on a Thursday evening, he's going to basically take you through some risk management skills and his view on how to trade and how to manage your own money. So really, really excited to have Garth kind of join the I suppose the content production at Transfers, which is really exciting. Happy to put his face up here soon as well. But yeah, so I'm excited about that. That'll be coming up. If you are interested in that, just look out for it. Like I said, events section of the website. It should be going up in the next couple of days, and you can go and register ahead of time. Of course, we do. We have to pay these guys, but we do it all for you guys for free. So, even though you might not be a Transfers client, one day you should come and check it out and try it. We're actually pretty good, as this says. Okay, without further ado, let's get on to the meat of the presentation, which is the, what's been happening in the world and what's been happening in financial markets. So, these are the headlines that we looked at last time. We had a big payrolls increase. Jobs market was pretty strong in the US. Oil was coming down. So, oil prices, just fell a little bit. Jerome Powell was quite optimistic. He was saying things like the US economy, currently isn't in a recession, even though technically it was, because 2 quarters of negative growth means a recession. But, the US can make up their own rules, and they can say, oh, well, it's not a recession because, basically we talked about the way that the US actually can have 2 quarters of negative growth, but then say that they're not in a recession, unlike the rest of the world. We talked about that last call. The NASDAQ 20% off the lows. The month before I'd explained those NASDAQ structured products that I thought were really, really interesting for retail clients. Obviously, if you had gone into the NASDAQ or one of those products, 20% up already. It has now come back down this month. So, maybe a nice re-entry point, but everyone was optimistic last month, man. People were crazy. They were really, the fear and greed gauge was neutral at that stage. So that's kind of where we chatted about kind of mid-August and how things have changed since then. Wow, they have changed. So still not the extreme fear that we saw earlier in the year. So we always have a look at the fear and greed index for anyone new on the call. It currently sitting at about 41. The fear and greed index is a composite of a whole lot of different kind of fear measures. So it includes the VIX, put call ratio, a whole lot of different measures that comprise this, and it tracks it over time. It's a really nice kind of little sentiment gauge that you can go and have a look at. So we're kind of heading back into fear. We're not at super fear yet. I think people are just getting used to the volatility. And why is that? So it's not because Liz Truss became the Conservative Party leader on Monday, although she did. So I thought I'd just include that from the Beeb. So that's not the reason the market is panicking. Certainly not, although she has a very hard job ahead of her. All sorts of things are going on. So one, if we just start on in the East, if you want to, China, I think people are very, very concerned about what's going in China, especially the big four banks. Just feeling the pinch from their kind of property sector. The idea that there's a massive bubble in China that potentially the authorities aren't aware of. We're seeing all sorts of indications that the Chinese property market is in a lot of trouble. And the Chinese response to this has actually been to cut interest rates. So while the rest of the world is grappling with much, much higher interest rates, the Chinese are actually cutting interest rates at the moment. It's one of the reasons that if you are building a portfolio, and I get a lot, obviously China's had a very difficult 2 years from an equity market point of view, with the ever since I suppose Trump and the trade war really began. And the world started to almost fragment into these regional zones, and everyone started trying to insource. And I think a lot of the benefits of this trend of globalization have started to reverse, and people and countries are becoming a little bit more insular. And ever since we saw that, the Chinese markets have been under a lot of pressure. People have been concerned about, the ADRs, so the American depository receipts that are listed on the NASDAQ. Are they going to be affected by regulatory changes? All sorts of trade bans coming up. As barriers to trade move up, it's been very, very difficult for a country like China, and their markets are, have been affected. We've seen record withdrawals from hedge funds, Western hedge funds out of China. So people have been selling down on Chinese bonds, Chinese equities. Their market's been under a lot of pressure. But with all of that said, China is a very risky market. And I wouldn't say go and put don't bet the farm on China. I would never do that. But it is nice to include a little bit of Chinese exposure in any portfolio. Now, most South Africans, we already have Chinese exposure via something like Naspers or Prosus, which sits in top 40 ETFs and a significant weighting. It's probably in your RA. You do have some exposure to China, but if you are acting like an international, a global investor, picking up something like an Alibaba or a Baidu or something like that at these levels, I don't think is a bad idea. Why? Because they're cutting interest rates, everyone else is rising. The Chinese economy kind of almost works in a counterbalance to the rest of the world. And I think having some exposure to it is interesting. And there's lots of different arguments for how you should get that exposure, but there's no question that the Chinese market is a very, very exciting market. So, but it is a market that is, going through some serious troubles. So if we start moving across the globe the other way, obviously Europe also in huge trouble. So I don't know if you've been following the Nord Stream 1 pipeline story, but it's all been about basically a Siemens turbine, and they've only been delivering 20% of the gas through Nord Stream 1, and obviously we all know what's going on. We know that Putin is weaponizing energy, but there's got to be a pretext as well. Oh, there's maintenance issues, etc. This week came out obviously escalating that dramatically, saying that until Western sanctions are removed, there will be no flow of gas through that pipeline. Now there are other pipelines that go into Europe, so it's not like it's the whole of Russian exports are at zero, but just highlighting. So it's highlighting that the Western sanctions are affecting, and they kind of couch the language in a way to say that Western sanctions are affecting their ability to do this. But they would love to if they can. But we all kind of know that Putin is trying to make any sort of sanctions or lashback against Russia very, very unpopular among the Western democracies, who are going to suffer from the much higher energy prices. So that's kind of crunching Europe, and we'll look at European energy prices in the commodity section as well. Got South African GDP, we'll look at that in the economic section as well. But our economy is smaller than before the pandemic. I mean, we've got our own challenges with civil unrest and load shedding and all those kind of, we all know our problems. So it's a difficult world out there. And then across in the US, obviously they're suffering with inflation. We'll look at their numbers now. But the US, I mean, you look at where the rest of the world is at the moment, and suddenly, even with the issues that the US are facing around, around inflation specifically, and around rising interest rates, it does look like a destination that is very, very attractive for investment. I mean, maybe, starting to switch companies, a lot of people switching out of equities, obviously looking at just holding dollars directly, seeing the reserve currency as important. We can chat about that. I didn't put a yen chart up, but US dollar is at a 24-year high against the Japanese yen. So as people get more nervous, as we see this gauge move into fear, people have been buying dollars. They haven't been buying yen. They've been seeing the US really as the safe haven economy. So I put this up last week. I'm just going to quickly touch on it again. Just remember that the situation that we're going through at the moment is a very abnormal situation. Only about a third of the time is a market in bear market, historically speaking. Most of the time, about a third of the time we're actually at all-time highs, and the other third of the time is kind of like a buy the dip kind of time. So, we are kind of almost back in bear market territory for the year. But we'll look at that a little bit later as well. But yeah, just guys, like if people are panicking and if you're worried about your equity investments, realize that it's very, very broad-based. And I'm going to show you a couple of measures of just how broad-based the sell-off has been. But just realize that if you look at the left-hand side of this chart, and I left it in for this month again because it is a wonderful thing to look at. Just realize that after significant dips, there generally is massive outperformance in equity markets. So even though the markets might be down 20% for the year, Nasdaq is down about 27% for the year. That generally means that the next 5 years, the next period, even the next 12 months, is going to give a much higher return. Now you can see in 2008, if you had been a little bit too early, maybe the next 12 months you would have taken a little bit more of a hit, but the majority of times, like when you get a sell-off like this, it's an opportunity to buy stocks. We kind of paused implementations last week. I said it in the call. I said we need to see what's happening on that S&P 500 chart. We'll look at that chart again to see what's happened. But it was kind of the right call, but we are starting deployments again now because the market is down 9% for the month. So it's definitely, for me, time to start kind of nibbling. I think your margin of safety on the downside is still significant. So what happened over the last month, you can see it's just a sea of red. The only place that you kind of have, okay, there's been some stock specific news items that have done well, like Disney obviously released kind of great numbers, market beating numbers. It's a little green patch because it's got a little bit of a tailwind there. So we still way prefer Disney to Netflix. It's a little bit of a different business, but so there are pockets of things, but you can see that, like, from a sectoral point of view, it's been all about energy. If you don't have energy, like, you're nowhere. And remember the month before we had energy coming off because oil prices are falling. That's starting to swing the other way again. So energy markets really the place to be over the last little bit. Looking at the international space, really Chile is doing really, really well, but they're obviously a big commodity exporter as well. So commodities have done well. Like I said, little pockets of green all over the place, but broadly speaking, just about every sector is negative, unless there's kind of like specific company news that's propping up share prices. It's a very global sell-off that we're seeing at the moment. So I'll just put an arrow up there at 9% down since, as I said, markets have fallen 9% since our August meeting when we met last month. And as I said, last month, we had that chart that had just hit that kind of downward trend line. And I said, guys, we've paused implementations. We're still sitting on cash. We're not deploying. Remember, we run most of our fund, most of our money in SEG equity portfolios. So we've got this wonderful ability compared to a unit trust to go and buy. But we can buy into stocks slowly. We can average into a portfolio over time. And we can go and buy stocks that have been punished, but we don't have to buy stocks that haven't been punished. So you don't just immediately get access to the overall basket, because we can kind of tailor it and pick your basket up slowly. But, kind of pausing implementations was definitely the right move last month, and we're down 9%. So now, still got clients complaining that we're sitting on too much cash. Why aren't we implementing faster for them? Because all we want to do is try and make you guys money. In the end of the day, performance is all that matters. I had a client, I was down seeing a client, and he was bitterly complaining to me that we hadn't implemented his European, because we've obviously got a European portfolio. We haven't implemented the euros yet. What's going on? And I kind of just had to point out, we've been sitting on them because ever since, he gave it to us just before Ukraine. We started a little bit in the initial sell-off, but he's probably still got about 70% sitting in cash. He's very angry that we haven't implemented. And I kind of pointed out the European, like if you look at the Stoxx 50, it was down 18.5%, I think. And he's down 4% because we've only done a 30% implementation because we're looking for that advantage. And he was still very angry with us. It's like, well, we've got massive outperformance. But either way, we are starting to pick up stock again. I think this dip might go a little bit deeper still, but I think you can start to accumulate positions now. You can see that little spike in the volatility. Obviously, the pre-pandemic volatility, we're still nowhere near the fear levels that we could be at. So this is not a market rout that we're seeing at the moment. This is, there could be a lot of, if real panic sets in, there could be a lot more downside. So that's why we're just being a little bit more conservative in the way that we're approaching things. Economic indicators, what's happening. Like I said, last month we got that kind of a bullish, or at least a dovish Jerome Powell. and we got a little bit of a beat on the inflation print, and everyone just went berserk, and markets went up massively, because you can just see how sensitive markets are to these interest rates. I mean, that's what every single market participant is looking at the moment, and kind of thinking in Europe, if you're sitting at a 75 basis point base rate, and you go up another 75 basis points, you're essentially doubling the cost of money. If you've got a villa in France that you've financed heavily, your repayments are going to double. It's very different from South Africa, where we're used to a slightly higher interest rate. And 75 basis points, it hurts, but it's in percentage terms, it's not nearly as much. I mean, I did a calculation with a client a little while ago. A 10 million rand flat in the UK, if you had financed it entirely, and if you see, like, let's say UK inflation going to 18%, which I've seen predictions of that, and UK interest rates having to go up that much, your 10 million rand property, imagine a 20% a year interest rate on a 10 million rand property. You're going to be paying 2 million rand a year in interest on that, where these guys are used to paying a couple of grand. I mean, it's going to turn these guys into forced sellers, like, if it happens. I mean, it hasn't happened yet. But yeah, there's still a huge disconnect between where interest rates are and where inflation rates are. And as you can see, federal funds futures, which is what we're looking at here, it's currently at 2.5%. Inflation is still running at 8.5% in the US. There's a massive gap between where interest rates are and where inflation is. Real interest rates are still deeply, deeply, deeply negative. So there's no question they've got to keep hiking. And I think, when Jerome Powell spoke at Jackson Hole this month, that's where the market just panicked, because he kind of, didn't say anything new, but I think the market was kind of hoping that he was going to blink, and he didn't, because he can't. I just don't think he can at this stage. I mean, there's no way any central banker can justify not increasing interest rates when you've got inflation where it is. So I don't know. I think this whole idea that you can keep monetary policy super loose forever, and they just print money and blah blah blah, from all the pundits that go on about it, and all the kind of two-bit analysts, you're kind of learning that you could have loose monetary policy when there was no inflation, but when there is inflation, you've got to tighten. So yeah, very, very interesting situation we're sitting at. We got the second print on the US GDP numbers, so it actually adjusted it slightly. So they revised up that second quarter estimate that kind of put them into a technical recession, even though they don't admit they're in a recession because the unemployment rate is so low. Yeah, so we've got that revised up. We've got the final print on GDP on the 29th of September. So, end of the month, we'll get the final Q2 print, and we'll probably confirm that the US is in a technical recession, even though they don't admit it, because they say their labor market is too strong. So looking at their labor market, okay, so we had non-farm payrolls out on Friday. Obviously, we got a very strong ADP number, which is the Wednesday number that kind of preempts the non-farm payroll number on Friday, which is the US unemployment rate, as well as obviously non-farm payrolls, participation rate. There's a whole lot in that, basically in that US Bureau of Labor Statistics pack. But yeah, so the one thing that was interesting, so payrolls came in at 315,000 jobs added. We were, like, market was expecting, consensus was at 300,000, so a slight beat on the amount of new jobs added, but that had moved up after the ADP number. We came into the week last week at about 250,000 jobs expected to be added. That moved up with the ADP number, so it's kind of in line with expectations. But I think where the market took a little bit of hope, when I say hope, the problem, like, you need to see the US labor market weakening a little bit, because that means that interest rates are starting to actually take effect in the US. The problem is, if you keep hiking interest rates and the economy keeps running hot, it means more interest rate hikes are coming. And then the idea of getting the soft landing is less and less likely. So what's happened here is, we got a little bit of a lift, so from 3.5% to 3.7% in the unemployment rate in the US. And I think everyone looked at that and went, "Ooh." And it's weird, because let's face it, bad numbers are good numbers these days. It often switches, because I mean, it's all about the expectations of what's going to happen in monetary policy. But people want to see a slightly weaker US labor market. They want to see these measures that the Fed are putting in place starting to have an effect, because the only way that inflation is going to come down in the US is if we see demand, being crunched a little bit. So or we see Saudi and OPEC pumping a lot more oil, and maybe we can get, like if oil prices really floor, if we go back to where we were a couple of years ago around pandemic time, where we had oil prices, basically trading negative. I mean, obviously that's going to take all the inflation out of the system. But I think, as I keep saying, I've said it in so many meetings, I've said it basically all my life since I was in university. OPEC kind of likes oil around between 80, let's call it $70 and $90 a barrel, in my opinion. That's the kind of optimum. I think with the supply shock now, they're kind of cashing in a little bit because people can't really adjust that quickly on a slightly higher oil price. But over the long run, that's kind of where they want oil. Below that is too low. Above that, I think, is too high. It's not to say, I mean, there's plenty of estimates from the big banks where you could still see oil going to $200 a barrel if you adjust it for inflation, where the peak was kind of pre-2008. It can go a lot higher. Okay, we'll talk about oil. It's just while we talk about oil quickly, just you saw that OPEC this week cut production by 100,000 barrels per day. It's not a big cut from OPEC, but it is a big signal that they kind of, after Biden went to visit the Middle East and kind of we got a little bit of a production increase after that visit. This is a reversal, and it's basically OPEC saying, like, we're going to draw a line under this oil price. We can keep it where we need it, and we don't want it to be nowhere, if you want to put it that way. We don't want to go back to those $40, $50 a barrel times. So I think they're all going to keep it higher. But remember, very, very high oil price, and you suddenly get, substitute products coming in. The rollout of nuclear and, EVs, etc., becomes much more attractive. If oil prices were at $1,000 a barrel, humans would find a different way to transport themselves around. We have the technology through the batteries and that, but then I suppose maybe battery mineral prices would be ridiculously high. But the switch is coming, but it's not here yet. Just looking at the SA economy, our interest rates also, you can see, kind of tracking international interest rates. We had GDP out yesterday. We kind of ticked back into ticked back negative. Expectation was for a fall of 0.8%. We got 0.7%, so it was actually a slight beat. We got the currency a little bit stronger on the back of that. It's since weakened again because the dollar is just absolutely unstoppable. Our next inflation print is going to be the 21st of September. So a couple of weeks' time. I think that's going to be very, very interesting because we so far seem to have avoided a lot of the kind of inflationary pressure. But I can't see us avoiding it for much longer, to be honest. I think we're going to be surprised by that print, to be honest. I think we're going to go a lot higher, but markets, I don't actually know where the expectations are. We'll have a look at it a little closer to the time. But yeah, I can't see, considering what's happening with European inflation and US inflation, the fact that we are this low, it's very, very surprising. The unemployment rate in South Africa, the one good piece of data in South Africa that's looking really, really positive is that our unemployment rate is starting to fall, just on a headline level. Is this viable? I mean, I think our structural issues are still very, very deep, very, very systemic. Until we get education right, which is a generational thing, our unemployment level will remain elevated because, unfortunately, the way the world is going, kind of unskilled labor, which is where the majority of our people fall, is going to become less and less important. So I'm glad to see it's ticked down a little bit. That's a good thing. A lot of it is government programs, etc. But sustainably, are we going to 3.7% anytime soon? Not in my lifetime, I don't think so. Still very, very difficult to see there. Commodity markets. So you can see commodity prices have actually come down over the last month. So we had a spike, but we actually ended lower than the last meeting. Part of this is, it doesn't matter where you put your cash, doesn't matter what you're looking at the moment. Everything is pretty much falling other than the US dollar. So these are just the two commodity indices. They're composites of a whole lot of different commodities. And you can see there has been a moderation, initial spike and then a moderation recently. That should take some of the inflation out of the system. But commodity prices are coming down probably because people are I suspect it's the demand is starting to flag. It will eventually. Oil markets, as we said, OPEC, a little bit of moves of OPEC. I've already talked about oil a little bit, so I'll skip this going into too much detail here. But yeah, you can see, I think the one interesting thing that you can see in the oil market is LCOC1, which is Brent, and LGOC1, which is European low sulfur gas oil. They are a little bit more elevated than the US gasoline and diesel contracts. And you can understand, I mean, that also just makes perfect sense. You can see the divergence. So they're a lot higher up than, sorry, not Brent. What am I looking at here? Yeah, Brent. 40% up. Sorry. Yeah, anyway, so a little bit of a divergence there anyway. But remember, that's just because basically the oil has to be moved around the world as well. So there's obviously the transport cost. So the divergence is probably reflecting the transport cost as well, depending on where you consume your oil and where your oil is produced. And if there's a long distance that you need to move it between places, contracts do trade at different values. So there is a little bit of a divergence between the oil contracts. And that's, I'm sure, just production, supply and demand and production issues. Other commodity markets, okay, so you can see, softs also, very, very mixed pictures. So over the last kind of year, the soft commodity that has kind of been most, from a price point of view, is actually orange juice, which is weird. So orange juice has been getting a lot more expensive. Japanese rubber has been getting a lot cheaper. And that's actually shown losses for the year. But I think the nice thing about the soft commodity performance, you've seen a little bit of a tick up in sugar prices, but overall, no major change in soft commodity prices. So the kind of massive food price inflation that is being predicted, and I think we are going to see serious food price inflation, but it's not run away yet. There's like the warning bells are kind of, I don't know what DEFCON we're at, but it's it's not panic stations just yet on the soft commodity prices. We're kind of moving. Last month we were looking at it, and I mean the power complex, especially the European power complex, was going absolutely berserk. Obviously, with the incredible things that Europe is having to face in terms of their energy crisis, and you could see it in all the underlying the underlying power contracts. You can see the big moderation there as well, just in the German and Austrian base load. But yeah, still very, very elevated for the year. I think people in real trouble in Europe, and suddenly all the naysayers around South Africa seem to have gotten a little bit quieter, to be honest. All the people that wanted to immigrate suddenly like, oh, maybe I won't go to Europe just yet. Let's see how this thing pans out. We'll just sit tight here and maybe look at the Western Cape as a immigration destination instead. But definitely Europe in a lot of trouble there. Okay, looking at commodity markets as well, you can see the kind of initial spike that we had after the Ukraine, in especially the grain and oilseed market. Obviously Ukraine a huge supplier of wheat, etc. That remained elevated over most of European summer, but there has been, over the last 3 months, a real moderation. And we're seeing, we're seeing that come off nicely. Remember, I don't know, Viv did a whole podcast about Malaysian palm oil at one point, and how it just was absolutely going berserk from a pricing point of view. You can see that's actually now come down significantly. So a lot of the supply chain issues, I think, are starting to alleviate. Could you have saved your portfolio by investing in the traditional safe havens like precious metals and the alternatives, gold, silver, platinum? Not at all. They actually had a very, very poor run, considering all the panic stations that we've been in. It really hasn't been the place to invest in kind of the traditional kind of metals. Gold, again, it's interesting. So from a South African point of view, if these are dollar prices, and one of the reasons that you see everything is coming down is because we normally measure everything in dollars, and it's actually the dollar that's moving. It's everything else is actually quite stable relative to each other, but it's this run in the dollar that we're seeing that's just making everything look like it's falling. So you've got to put that in perspective as well. when your stock is down 10%, but the dollar is up 10%, maybe your stock hasn't moved in rand terms, and a lot of South Africans, I mean, we always encourage people when you have an offshore portfolio and you are South African, you don't convert every day. We measure in dollars, we look at it in dollars, but every now and again, convert it back to rand, you'll see there hasn't been a big move there hasn't been a big fall in underlying rand value, because obviously we've seen the rand blowing out, which we're going to look at next. But yeah, precious metals in dollar terms haven't been particularly good as a safe haven. I don't want to be called a gold bug, but I still think that there is a place for gold in people's portfolios. And for me, it's always the zombie apocalypse hedge. Would I go? I don't hold gold ETFs in any of our client portfolios. I kind of feel gold is, it's something that it should be a little bit of fun as well. So you should either buy Krugerrands, and we can supply the Krugerrands through our stockbroking license. Organized transport, all of that for you. You can buy them on screen. You normally get a discount to buying them through the numismatics dealers. So if you go to like one of these shops and buy a coin, please never go and buy the special coins that they give you. You just buy the bullion directly from them. It should be basically the gold price plus the 5% premium. But if you look in rand terms, like Krugerrands, for example, haven't done particularly badly. Neither is the new gold ETF. But back to what I was saying is, I like gold as like the zombie apocalypse hedge. It's when the whole fight, it's your little bit, like your 2% or your 5% of your portfolio, and when everything collapses and there's no banking system anymore, you've still got a little store of value. Viv always laughs at me when I say that, because he says the only thing that you can do there is you've got, it's whiskey and gunpowder. You've got to stockpile bullets and that. But of course, that's, in that world, we're not thinking about financial markets anymore, because we're all trying to, run for our lives. But has gold been a safe haven? No, it hasn't. Okay, looking at the currency market. So we've been making very, very good calls on currency over the last couple of presentations. So like I said, last time I was really torn, because this is actually, so I've got this as September, this is actually the chart on the left hand side that I showed you last time. I haven't updated so these are the old estimates, but I just wanted to leave this chart in. So you can see that level here, that's where we were last month, 1643 on the chart. And I was kind of torn. I was really torn. Is this going to go up, or is this going to go down from here? And normally I give you, I'm going to give it to you every month. I give you kind of my range, that if I was to be investing offshore and I was going to be buying dollars, where would I buy dollars? Why do I do this? Because we have a lot of people that are immigrating that use our treasury service, as well as people that are investing in portfolios or just internationalizing their private wealth from a South African point of view. So I always give a kind of range. And I was torn. I was like, I don't know whether we're going to break the bottom of this channel and go back to kind of that go back to that long-term support down there at kind of 15 to 1530, or if we're going to bounce off this upper support. And I kind of decided, no, I'm going to say our range is 16 to 1630. So that's what actually happened. So I'm happy that we made the call at 16 to 1630. It actually traded below 1630 for like it was a couple of hours the day after the presentation, and then it's just gone absolutely berserk. So I haven't moved any of the lines on this at all. So you can just see I've just basically drawn technical channels on it for you. And you can see that channel broke out, and it's kind of now started to build its second channel, and we've got the second kind of like almost touch there. Those two lines, they are parallel to each other, and you can see it was a breakout, and we're now kind of touching. You see, if I join those two lines there and we build a channel that way, it's touching that top one. It's kind of become the resistance level. It's come off. We're sitting at resistance now at kind of like 17, call it 1738 is where it was this morning. It's about 1741 now. But yeah, that for me, this is a kind of a key level. So would I be saying ship out all your currency now into dollars? Probably not. I think you're going to, we might see a break there. And if we see a break there, then we're going all the way up to sort of like 1820, 1830 before we catch the top of the channel again. And I think your support will be up here somewhere if we break this level here. My feeling is that you're going to slowly drift down back to the bottom of this channel here. So I think kind of 1650, I think I put the levels here, like, I mean, aggressively 1650, if you really need money out because you're immigrating or whatever the story is, 1660, 1670, I think is where you're going to see a pullback here. Looking at the big bank estimates, so we had 18 forecasters this month polling. There wasn't a lot of change. It was kind of very static. So we saw big changes last month. You know, a lot of the banks and brokers upgrading like basically weakening their targets on rand dollars, so upgrading their view of the US dollar. And you know, we saw a big move out there, and that's kind of, I think, maybe prompted some of the move now as well. But yeah, very limited here. So the median estimates of that measure of central tendency of the 18 polled has actually moved down to 1620 is kind of the median. The smart estimate sitting at around 1640, which is also just another measure of kind of like working out like where the average pick is. I always put like the min and the max is always useful to me, because where it kind of gives me the range on where the economists at the big banks who advise their clients, who, you know, do billions and trillions in FX transactions, are putting their outer limits. You know, that's where they're advising their clients. That's where they're seeing value or not seeing value. So the most bullish on the local currency, most bearish on the dollar is Swedbank. They think we're getting back to 15. The most bearish is DZ Bank at 18. And you know, that just gives me a range. So if we're sitting at 1740 now, for me, from a technical point of view, you're at the top of the range, and from a where people have been, where the big banks and brokers are expecting the currency to move in the next 12 months, we're very much getting towards the top of the range. If we were to break this line and go to the 1820, we're outside the most pessimistic analysts' view of where this would be in 12 months' time. So for me, you know, if you're taking like a trade on a currency, I would probably be going long rand here, short US dollar, and just looking for that retracement. If you're a shorter term trader, again, remember that interest rates are a lot higher in South Africa. So, you know, if you're thinking, I want to move money out, it now becomes a little bit of a question, and I'll talk a little bit about it later on as well. But the question is, markets are down. If you want to invest, you know, you've got to think about it. If you want to invest in the US or Europe and take advantage of these very, very low prices, you know, if you wait to move the cash, so if you wait for this to get to 15, let's say in a year's time, and you're going to remember, you're going to have a year's worth of interest. I mean, I actually did a stock pick on business day. I mean, the market, it was literally just after the presentation I did last month for you guys, and the market was at the market was at highs, and I knew I'm going to have to now do a pick, and they're going to track us, and they always post the stuff on websites and all of that. And I thought, oh, I don't want to go and pick a stock here, because I don't have any conviction that I really believe that the market was going to come back in the month as it did. So I picked the Nedbank fixed deposit. Nedbank fixed deposit at the moment was giving you 8%. So Investec, I could put it up now. Their rate is now caught up. So a 1 year, so 12-month fixed deposit Investec, we can give you basically 8% in rand. And then on top of that, I think you are going to get a little bit of a strengthening over the next 12 months in rand. And you've got that interest component as well that you're going to earn. Now, sure, depends on your tax profile. You know, interest is going to be deemed as income unless you know, if it's an amount above your exemption. So just be aware. This isn't a blanket statement. I'm not giving you financial advice on this. I'm just saying where I think the currency is going to be. I think the currency is going to get a little bit stronger. So sitting and earning a little bit of the higher interest in South Africa for a while that currency comes down, not a bad idea. The problem is the trade-off is going to be what happens when the currency is down at, let's say the currency does get back into sort of the 15s. You know, let's say we go back to sort of, I don't think we're going to get there. I think we're going to the bottom of the channel. I think kind of 1630 to 1670 is your exit. But let's say we get back into the 15s and it takes, you know, 2 years to do that. By the time we get to the 15s, I'm telling you, the market overseas would have recovered. For us to get back into the 15s, you're going to have to see risk on trade coming back to the market. Risk on trade is going to boost the rand dollar rate, but it's also going to boost equity markets overseas. So you're going to lose the ability to what you're going to invest. If your plan is just to go out of the country and take and sit in a dollar balance overseas and not actually invest in any sort of tangible investment product, then I'd much rather you just sat in South African rand for a little while. because you're going to get the interest, and I think you're going to get a little bit of a movement in your favor. You can see just I put the 14-day wilder RSI back on at the bottom. You can see we're kind of heading back up into overbought territory. So this is an oscillator. When it gets to the top, you sell. When it gets to the bottom, you buy. So my view at the moment, long rand. We'll see how that pans out in the next month. If we get a break and we're trading at 20 next month, then I'll come back to you and say, sorry, trade was wrong. But I don't think I'm going to be wrong on that one. Okay, quick look at the dollar index. Dollar index at 110. Massive. It's unstoppable. This is literally the only thing. Holding dollars has been the only trade over the last, say, four months or so. You can see, and I just left this picture on as well. A lot of people are kind of going, oh, I can't go on for too much longer. Just remember, like, if we compare this, and a lot of people are comparing the period that we're in now to the 70s and 80s, where we had a big oil price shock. Dollar index was about 160 at that stage. So the dollar can get a lot stronger. You're also looking at kind of 120 in kind of like, kind of .com era crises. But yeah, the dollar is incredibly strong. And as I said, it seems to be attracting assets ahead of just about any other jurisdiction globally, well ahead of Japan, which is another typical safe haven state like investment. And gold is just not even on investor radars. Crypto, we're going to talk about crypto. That's just a mess, isn't it? Okay, other two currencies, so euro and cable. So euro dollar, pound dollar. Also euro below parity now to the dollar. Dollar is just so strong, strengthening against the euro. Same picture on the cable. You can just see that pound is getting beaten to pieces by the dollar. People are now starting to talk about pound dollar parity instead of euro dollar parity. So pound, $1 equals 1 pound. I mean, who would have thought? But dollar run is absolutely unstoppable. And now you can kind of see also, like, if we compare the rand to the pound, you can see that this, like, while we have, all the currencies have been obeying my channels very, very well for the last couple of months. But yeah, we're still down in this channel. We haven't broken any lower, but you also haven't seen that big ramp up that we saw in the US dollar contract. And obviously that's just because the move hasn't been into pound. The rand has been stable against the pound. The rand has been stable against gold. The rand has been stable against everything. Has been like, things have been quite stable against each other. The big mover has been the US dollar. And you can see the same picture in the European market. This one, remember, I said I was getting a bit lost here because I had a trend line up there and it kind of broke below. So having a look at it, yeah, you've now, in the last month, you've kind of made these this kind of like two touches of this trend line here. So if I draw there and I create the channel, it's starting to make sense as an upward channel now. We're kind of mid-channel on the euro, so I'd probably be buying euro below 17 rand to the euro. Selling euro, I think you could easily get a spike out. I mean, our internal politics is, I think, we're very accustomed. I was going to do a webinar about the grey list and what the potential impact of South Africa moving onto the grey list is going to be. It's going to be significant. If something like that happens, 18 rand to the euro, no problem, no problem. Remember, we are a risky destination anyway. There's a reason people buy rand when it's risk on, not risk off. I was a little bit more. I said kind of 1630 to 1670. Okay, so the one that I officially went with is 1630 to 1660. That's where I think the zone to exit is. I wouldn't be taking currency out just yet. I'll just wait for that to come down. Again, I put the quote up at the top here: balance entry opportunity against exit. So everyone wants to get the best exit. If you're investing in offshore markets, everyone wants to get the best exit on their currency. They wanted to get the perfect. Everyone wanted to go out when it was at 14.20 in hindsight. The problem is, like I said, balance that exit against where you're going to have to enter your new financial product. Because let me tell you, if you wait too long, the markets are just going to be at record highs again, and you're going to lose a big run up overseas. The best advice, or the best view that I can give you is try and get your funds into the places that you want them to be for a longer period of time. Sitting in time and knowing that you need money in the equity market in growth assets, and then sitting in a cash asset because you're waiting for the best currency rate to get out at, but then you're kind of prejudicing prejudicing yourself because you're in the wrong asset class is far more dangerous than getting a slightly worse exit on currency. Whether you exit at 1680 or you exit at 1640, I don't know. I kind of like guys get very bogged down in it. Maybe it's because we keep talking about it in this webinar. Cool. Okay, so portfolio ideas. Okay, I've got 10 minutes to go. I'm going to try and keep these to an hour now. So this is my portfolio ideas. I'm going to run through the portfolio and I'm going to run through the two investment ideas. Now, the first one isn't really an idea. It's just a really interesting story that I had to do for a show, and I thought I'll share it with you guys. So I don't know if anyone here knows about Fortress A and Fortress B and what they are. So Fortress, the Fortress REIT is basically, it's a South African real estate investment trust that specializes in logistics and retail property and all of those things. I've got up on the right-hand side, its segmentation. So it kind of does a lot of retail. So it's got a lot of retail exposure. Its big strategy at the moment is to push into logistics and warehousing. Just with the rise of online shopping, that's where they're seeing the advantage in property. I like that. I think it's, industrial is kind of limited at 15% of the REIT. Commercial is also not massive, which is also nice because, office, I'm sitting in an office in the JSE, but I'm telling you, like, although the rest of our staff is still working from home most of the time, they come in now and again, but you can, I think office is going to still be under pressure for a while, but they have very limited like office exposure. So mainly retail and logistics. Remember that I'm telling you, they've got a big stake in Nepi Rockcastle as well. So they've got Romania and Polish property. I've actually just come back from Romania, which is interesting. I was there for 3 weeks. Romania is a very interesting destination. Like, in a way, it's European and very similar to South Africa, in that everyone is super pessimistic there. You speak to young Romanian people about Romania, and they're leaving. I think there's been 6 million Romanians that have relocated in the last couple of years into Europe, because it's obviously part of the EU. Like, kind of asking everyone, just chatting the feel on the ground of like Romanian business and what does it mean, with the Ukrainian war going on next door, because remember, Romania borders on the Ukraine. And I'm telling you, everyone is like, they're part of NATO. They've been part of NATO since 2004. There's no worries. I was asking people, aren't you worried about refugees coming across to Romania? They said, refugees wouldn't choose Romania to come to. They'd rather stay in Ukraine. So very, very negative people, I'll tell you that. But actually, very, very interesting. I think a lot of opportunity there. Some of the shopping centers we went to were really, really shocking. So maybe a little bit of opportunity for development. I was in Poland about a year and a half, 2 years ago. No, about 3 years ago, sorry, not during COVID. I didn't manage to go to Poland during COVID. It was 2019. The development in Poland is insane. Walking around Warsaw, you look at the amount of construction that is going on, and it's incredible. So a very vibrant. Poland, I think, is really moving from strength to strength. So that's Nepi Rockcastle's exposure to those two areas that, especially retail exposure, so big malls, etc. Both European Union kind of countries, and obviously Europe going through an energy crisis, which is obviously applying some sort of discount to this. But hear me out here. Fortress owns 23. So Nepi Rockcastle is 23% owned by Fortress. Nepi Rockcastle's market cap is about 55 billion. So that accounts. So if you don't apply a discount or anything like that, the carrying value. So if you're doing like a sum of the parts model, 12 billion, almost 13 billion of Fortress A's market cap is Nepi Rockcastle's listed securities. So and we've got a listed price for that. So you don't need to worry about anything else. That's what the shares are worth. That's what they get. Now you can apply a discount because there's Romania. There's lots of ways that you can kind of understand the valuation. The total market cap, which I've got there, and you can see the market cap has collapsed in Fortress A over the last little bit, is 16 billion. So this is basically a Nepi holding company. If you apply a small discount to, a small percentage discount to Nepi's assets, that accounts for the whole of Fortress's market cap. It's almost getting like a Naspers situation. The rest of the assets you can have for nothing. So because Nepi is accounting for most of the value in Fortress. So now why is that? Okay, so now, so just to explain the other, so they do have a whole lot of other assets. They've got things like, I'm a Santon and Joburg boy. So, I know Pine Slope Shopping Centre out in Forwards. That's what I know them. They kind of have a business, like a quasi like retail and business park around like Design Quarter as well. But you guys can see majority Gauteng, KwaZulu-Natal, Western Cape, and there's all their malls. Vescas Mall, the Plaza, the Galleria, all sorts of things. So it's not like Growth Point, which is like V&A Waterfront. It's not those kind of big properties. It's like these kind of almost drive-in properties that they own. But yeah, so they have plenty of assets that are outside of the Nepi Rock Castle holding. So why is this trading at such a large discount? So let's go and look at what the analysts have to say. So they haven't updated in a while. So you've only got 3 analysts that cover this company. That's Nedbank, ABSA, and Investec cover it. We've got 2 holds and one buy. So they've actually, they've down rated it. It was the last move, but currently you've got 2 neutrals, 1 buy. So Investec has a buy on it. And that's it. And now, so why is this looking so shocking is the question. So there's a lot of confusion about Fortress A and Fortress B. So I thought, let me first just clear that up. And it's this confusion, I think, that is applying a discount to the stocks. So first, Fortress A and Fortress B, you can see them both. If you type them into your system, you'll see Fortress A and you'll see Fortress B. And we'll look at the differences between the two in the next slide as well, just from a stock point of view. But at the moment, they have equal voting rights. So if you buy a Fortress A share or Fortress B share, you have the same amount of votes in the thing. Fortress A has a preferential right to capital protection on winding up. So they've basically insulated it as a quasi-pref share. Fortress B just has, if they were to wind up the property, Fortress A basically gets everything and Fortress B gets anything that's left over, because they kind of apply a floor of R8.11 to the redeemed capital. So that's kind of like you're thinking about that from a risk point of view. But the big difference is, as a shareholder, is what your distributions are going to be. So the Fortress A share, there's a dividend benchmark, right? So every year there's a dividend benchmark, which has to escalate by either CPI or it has to escalate by 5%, right? Whichever one is lower. So at the moment, CPI is higher than the 5%. So you'd be escalating your dividend by at least 5%, right? All the distributable earnings are paid to Fortress A shareholders, and Fortress B gets nothing unless there's a residual left over. So Fortress A, you're basically taking all of the income of the company. So even though you have equal voting rights on each share, Fortress A gets all the money, it gets all the benefit of distributions from the share. Now remember, this is listed as a REIT. That means in South Africa that it has to pay out 75% of its distributions have to be paid out. Now, who's going to get those distributions? Fortress A shareholders are going to get the distributions. If they're so wildly profitable that you've paid Fortress A either their benchmark plus 5% or their CPI distribution, then Fortress B shareholders might get a little bit extra, right? So that's kind of the current situation. Now, why is the market panicking about this? Because it clearly is. Let's have a look at what's happened to the share prices quickly. And sorry, I've just put up the analyst and I'll do there. Fortress A is trading at R9.96 per share as of today, and Fortress B is trading at R4.43 per share. Right. So now I'm saying buy Fortress A because yes, they equal voting rights, but you're going to reap all the benefits, right, of the share. They have the same claim on underlying assets. Both companies' market caps are, when I say same claims, that obviously not quite the same claim because you've got that additional pref share kind of protection on Fortress A. But essentially the underlying business that you're buying into is the same underlying business. So looking at it, what's happened to the two share prices? Fortress A is down 41% over the last 5 years. Why is all property shares have been hammered on the JSE over the last little bit? So that kind of explains why Fortress A has done so badly. Nepi Rock Castle is down. You're getting the pricing off Nepi, obviously, because Nepi is the big asset that it owns. It's obviously going to fall. Property has been under a huge amount of pressure with rising interest rates and with COVID and lockdowns. And we know how many landlords have been, they've been screwed. Tenants just haven't paid. Businesses have got under. I mean, it's been a very, very difficult period. One of the reasons the share price is down. But why is the share price of A down 41%, but the share price of B is down 88%? Yes, because of the preferential structure. Looking at the analyst recommendations as well, Fortress B, 2 sells, 1 hold. Fortress A, 1 buy, 2 holds, right? So analyst community, banks are definitely saying Fortress B is rubbish. Fortress A is where you want to be. That's what the market is expecting. So now what's actually going on here between the two? So one of the problems that the company is facing is that it's got a scheme of so basically the management team by the CEO Stephen Brown has proposed to the market, so it's proposed to all the shareholders that they collapse the shareholding into a single shareholding, right? So that they get rid of this legacy kind of Fortress A shareholders just get everything and Fortress B get nothing except there's these weird voting rights. It's a complex structure that no one likes. Complex structure. No one likes complex structure. The shares trading at discount. Maybe if we collapse them, we're going to get this big value uplift. You know, the move on the exchange recently has been just getting away from complex structures. So he needed 75% approval, and what was offered was that basically you could trade 3 Fortress B shares for 1 Fortress A shares, but they needed 75% approval to do this. Now, currently, if you look at the share price of the two companies, that seems kind of reasonable based on where the share price is, because the current ratio is actually for every 1 Fortress B share that you own, so for every 2.4 Fortress B shares you own, that's the value in monetary terms of a Fortress A share. You know, if you take 996 divided by 443, you get 2.24. Now, the problem is the Fortress A shares have this additional value because they are going to scrape all the distributions. So 75% vote required, put it to shareholders. Shareholders said, are you mad at 3-1? There's no way we're giving up there's no way we're giving this up. I mean, we want the structure to remain as it is. So the next hurdle came about now. So obviously a REIT has to distribute 75% of its income, as I said. So you have to pay out 75% of taxable earnings. The problem is that the memorandum of incorporation, so the document that created the A shares and the B shares, says that the dividend benchmark must be applied, but there's limits on the dividend benchmark that have to be applied. If there isn't enough distributable earnings to match like this, the benchmark plus CPI or the benchmark plus 5, depending on which one is being applied, then no dividend can be paid. And if no dividend is paid, they're going to be in breach of JSE listing requirements because they're no longer a REIT. So it's a mess. You've got one thing saying that they can't do it, and they've got another thing saying they can't do it. So what the management team has said was, well, now we're stuck. We've got to go with our memorandum of incorporation. We are not going to pay any dividend. And I've got it up there. How close are they to paying a dividend? Their distributable earnings, in the first half of last year were 830 million. The benchmark at that stage was 979 million. They needed those distributable earnings to be 18% higher, and they would have paid Fortress A shareholders a dividend. Second half, their distributable earnings were 876 million. The benchmark was at 967 million. So about a 91 million rand shortfall. They needed 10% more earnings, and they could have paid the dividend, but they didn't. Meanwhile, just bear in mind, behind the scenes that no one is talking about, there's also a share repurchase scheme going on, right? So as well as buying this, okay, so remember, a share repurchase scheme is a way of also, it's almost like a dividend because you're not paying a dividend, but you're buying back your shares. So you're essentially returning that value to shareholders because you own a share. Now the company owns other people's shares. Your share has more of a claim on those earnings. So your share is actually more valuable. Your EPS, you're going to get more earnings per share, basically. So they're busy buying back shares and underneath this as well. How much did they buy back shares in the last reporting period? 385 million of share repurchases. So the numbers aren't adding up for you now. If you're paying attention, you're probably seeing that the numbers aren't adding up. Why are they spending so much on share repurchase, but they don't have enough earnings to distribute? Okay, interesting question. So what's happening now? Okay, they can't pay the dividend because they haven't got the distributable earnings. They can't pay the dividend because they don't have the distributable earnings, but they can't not pay the dividend, otherwise they're going to lose their REIT status. So what's happening now? So basically, the management team has said, well, we can't pay your dividend, you as shareholders. We're going to go and engage with the JSE. Okay, so we're going to go and engage with the JSE. Now, what does it mean? Okay, so because they're potentially going to lose REIT status. So like I said, like on the 31st of October, this is when they essentially, so as a REIT, 4 months after you release your results, you have to have paid that distribution. So that deadline is the 31st of October, which is coming up. Before then, there has to be a resolution. We don't know what the resolution is. This is why the share price is in, this is why I believe there's a discount in the share price, because there has to be some resolution. There's this big mess around this thing. Now, to add kind of insult to industry, I've seen a lot of activist shareholders talking about this as well. If you have a look at, so this is Stephen Brown's holding and the management team's holding. It's right at the top of the report. They're not trying to hide this in any way. But you can see if you go through this, and I mean, download the presentation of YouTube. We send it around to you guys afterwards. Go and look at this, or you can get it off their website as well. You can see the management team has a massive amount. They have a far outweighted amount of B shares compared to A shares. So there's been a lot of rah on Twitter and in financial market circles that the management team, even though they have independent boards doing this and all that, they are kind of not independent because they obviously want a better deal for B-class shareholders than for A-class shareholders. So there's this kind of like ruckus going around. So no one likes the share because, you know, all of these things are happening. So what happens next? We don't know. We don't know what happens next because that's markets. And then, like I said, next episode is airing on or before the 31st of October. So I think it's an interesting one to watch. Now, from my point of view, if they're doing share buybacks, this business is, from an operational point of view, pretty solid. I think they've got good assets underneath this. The ruckus around the A and B class shares are it's a distraction in my opinion. There has to be some sort of resolution, whether they collapse it or not. What happens, and everyone's panicking about what happens if it's, it loses its REIT status. So what is the difference between a property, what happens if it becomes a property company that isn't a REIT, and what happens if it remains a REIT on the exchange? It's basically a tax dispensation between the company and the shareholders. Like with a REIT, remember, REITs, the company doesn't pay tax on the distributions, but it comes to you in your personal name as income. So if you're a 45% income tax holder and you hold a property REIT, that distribution that you're getting is not the same as a dividend of a company. Remember, dividend, the company pays a 20% dividend withholdings tax, and you get that dividend tax free. You've paid tax, the company has paid the tax for you. Tax is your responsibility, but the company pays it. So you don't have to do anything with the tax, and you just get your dividend. It's a nice clean dividend. The difference with a REIT is that income that comes to you as income. So if you're a pensioner and you've got your property shares that are paying your distributions, and you kind of look at your tax tables, and you're above a certain age, blah, 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 your tax is pretty reasonable, and maybe you want it to come to you as income. If you're a 45% tax earner and you're holding this, you probably don't want it to come to you as income. You know, it depends how you're holding the share. If you're holding it in a foreign trust or something, I mean, maybe you do want it to come as income. I don't know. Question for your tax advisor. But the point, because that's your kind of personal situation, the point is, if it does lose REIT status, it's not the end of the world. It just means that the company is going to pay the tax, and it's going to declare dividends and pay the withholding tax, and you're going to get it tax-free. You're not going to get it coming through as income tax. So it's really a tax arrangement between the company and the shareholders. It's really not the end of the world, but the market is treating it like the end of the world. So for me, a company full of assets, where you've got a listed asset that accounts for most of its market cap, a lot of other stuff, this just seems like a bargain. Now, I'm qualifying it because, like I said, I haven't chatted to the analysts about this, and I'm a portfolio manager, so I look at lots of different things. And this is just something that I looked at over the last week that I found really interesting. So, I mean, by all means, go and do your own research on this one. But I thought an interesting story, and it looks like a company that's at a big discount. And I think you could potentially be getting into an asset that is going to have proper tailwind. Thanks, everyone. You guys make answers possible. Thanks a lot for attending.